Hello everyone, class. This is our explanation or discussion about lease accounting using the PowerPoint slides and my narration. So let's look first of all at how we classify leases under the new lease accounting standards. So the first thing that we have to consider is when we have a lease, what kind of lease is it? Now, a lease is a very broad description of a contract where we get an asset and we pay for that. And the issue is really about control. Do we control that asset? And that's what drives whether or not we, how we record it. So under the new standard, they carved out an exception to the lease standards with regard to anything that was cancelable with a less than 1 year term. So a rent, month-to-month arrangement that you might be familiar with would not be a lease because it's cancelable with 30 days notice. A 6-month lease of a piece of equipment for short term because you used it for the growing season or for the summer when you're busy, that would not be a lease under this standard because it is less than 1 year term. That would still be recorded as rent expense and cash, so just like we have all along. So that exception still exists. Outside those exceptions, that exception or those couple of examples, everything else is going to be fit under either a finance or an operating lease. So basically, the way that we look at this is we first decide, is it a finance lease? If it's not, but it's still non-cancelable and such, then it's an operating lease. So finance lease is more restrictive, more specific, and then if it doesn't fit that, it must be an operating lease. So to be a finance lease, you have to fit one of these criteria. At the end of the lease, the ownership transfers to the lessee. There's an option to buy that is reasonably certain, meaning that the option is for a price at the end of the lease that is low enough that the person buying it would certainly not turn it down. So you might see a bargain purchase concept where it might be $1 at the end of the lease. Sometimes it's considerably more than that, but as long as it is less than what the fair value of that asset would be, then of course most likely the lessee would go ahead and buy it at the end of the lease term. Major part of the useful life, meaning most of the useful life of the asset, the lease term is at most of that time. So if it's 10-year useful life and our lease is for 80% or 8 years, then that would probably be considered a major part. Now there is no set percentage anymore. That's the difference between having a specific rule and having a principle. The principle is a major part of the useful life. Or is it substantially all of the present value? So if you look at the present value of the payments, is it substantially all of what it would cost to buy the asset outright? What's, a sticker price, you might say. Then on the lessor side, the one that is providing the asset and receiving the payments, they have to ask themselves another question before they can record it as a finance lease, and that is, does it transfer control? Do we actually give up control of the asset? And are we is it probable that we'll make all the we'll collect all the payments? So are we going to get the money? So that's when you start looking at the ability of that lessor to pay, the lessee to pay the payments. Now, if it don't fit that, it must be an operating lease. That's everything else that is non-cancelable past 1 year. And operating lease is going to record a right to use asset and liability. That was the new terminology used in this new standard, is the idea of a right to use asset. So how do we record this initially? When you first start the lease, on the day it's signed and everything is agreed to, we look at the present value of the payments to be made. The asset is equal to those present value for both the finance and operating leases. So for this part, it doesn't matter which it is, finance or operating. You're going to take the present value, use your present value principles we learned earlier. The thing to remember on leases is the payment is at the beginning of the period. So you're going to have to use your Excel skill to change the payment to be considered at the beginning of the period instead of at the end like we did in earlier problems. You would add the direct costs to the asset part of this situation. That's the cost that you paid out, like commissions, to get the lease set up. Those are not very common, but they may come up. That's specifically mentioned. Liability is also equal to the present value of the payments to be made. So the end result is a debit for an amount and a credit for the same amount, almost in every case, except when there's direct costs. Now, purchase options and guaranteed residuals are considered payments. So if you were looking at what payments we need to take the present value of, you look at the lease, you say, okay, each year or each month I make this payment, and then at the end of the lease period I have a purchase option, or I have a promise, a guaranteed residual. Means that we're going to give back the asset, but we guarantee that it's going to be worth a certain amount. Those are all considered payments. And so we're going to use the interest rate explicit in the lease, that's what's stated in the agreement, or if there is no interest rate in the agreement mentioned specifically, then we'll use the incremental borrowing rate of the borrower. So back to the idea of purchase options and guaranteed residuals. Those are probably not going to be the same as the payments. So you're going to have a situation where you have equal payments for part of the time and then a payment at the end of the lease term that is a different amount. You can do that in present value. We learned how to do that previously by simply putting in the equal amounts in the payment argument, and then the future value, end value, is the amount of the guaranteed residual or purchase option. So, an example, if you were at a 5-year lease, you would take $60,000 per year at the beginning, plus an option to buy at $10,000, plus the rate is 5%. You would put that in as present value. All right, the interest rate would be 5% per year. The payment amount would be $60,000. The number of payments would be 5, and then the future value, the end amount, would be $10,000. And then because it's at the beginning of the period, you would put a 1 at the end of the arguments to tell them that it's at the beginning of the period. Now, once it's recorded, then things get a little different between the two leases, two types of leases. Finance lease, you record interest expense. All right, so just like a loan, you would record interest expense, and you would record the payment of cash and the reduction of liability. So you're going to credit cash, you're going to debit the lease liability, you're going to debit interest expense. You're also going to record depreciation for on the lessee side, the one that is using the asset gets to record depreciation on this right to use asset. It's either the shorter of the lease term or the useful life, unless ownership transfers. If ownership transfers, you use the useful life, not the lease term. So if the ownership transfers, use useful life. Operating lease, different types of journal entries. You're going to record the total lease expense divided by the number of periods, straight lines. So it doesn't matter how much you pay each time, you're going to add up all the payments, divide by the number of payments, and that's the amount of lease expense that should be recorded each period. Monthly, annually, doesn't matter. That's how you're going to record it. You're going to credit cash because that's for your payment. The difference between your expense amount and the amount of cash is going to either affect, well, usually the asset, the lease asset. And then the hardest part of this is you're going to recalculate the present value of the remaining payments. So it'll be one less payment than you had when you started. You'll do the present value again. You'll figure out this new present value. You'll take the difference between the new present value and the old present value, and that's the amount you're going to debit to the liability and credit to the asset. That's going to reduce the asset and reduce the liability. So both are going to be going down each time you make a payment, but not by the amount of the payment, but by the amount of the present value difference. All right, lessor, this is the lender, this is the one providing the asset and this financing, okay, is going to record a finance lease like a sales type lease. They're going to credit inventory or asset for the cost. They're going to record a lease receivable for the present value of the cash flows. So that's very similar to it's the opposite of what the lessee putting in a liability. The lessor is going to have a receivable. They're going to record the residual asset, the present value of any unguaranteed residual, and the difference is going to be profit. All right, so they're going to have lease receivable and sales and credit inventory and debit cost of goods sold. All right. If it's a direct financing lease, all right, the present value of the lease payments and third-party guaranteed residual is equal to the value of the asset. So you're going to credit asset and you're going to debit the present value of the lease receivable. Okay. Usually you're not going to get any profit. So that's the difference between a sales or a sales type lease and a direct financing lease, because there's going to be no profit on the actual sale of the asset, simply interest over time. Now, a true operating lease for a lessor does not record anything at the beginning of the lease, only the rental income or lease income on a straight line basis over the life of the lease. Subsequent years, okay, you're going to record the interest and the cash on the sales type and direct financing lease. Operating leases, just lease income on a straight line basis. Okay, difference between lease income and cash affects the unearned revenue, and you're going to keep depreciating the asset because you didn't give up control of it. On an operating lease, so you're going to continue to depreciate it. Only one side should be depreciating the asset. So a couple of things about the difference between leases and other payables or other receivables, both sides. Remember the idea of payments at the end or the beginning. Leases are usually at the beginning. Most loans are usually at the end of a period. And leases, the asset and liability, are really not separate. They should go together. They should be very similar to the same amount for the most part. All right, that's different when you buy an asset and the liability is really a separate transaction, a separate issue, and the liability is reduced at differently than the asset is depreciated. Okay, but all loans, all leases have a present value of future cash flows. They have a value that could change, and both can be impaired if there are changes to those future cash flows. Both the liability and the asset can change in value. We talked about impairment in an earlier week. Those also apply to leases.